fund management is, traditionally male dominated. Do you feel any difference?
People have their strong biases that, this role is good for a woman and this role is good for a man. The good thing about fund management is that the outcome is measurable.
You have a high conviction idea, but the markets don't support. How do you then deal with that?
So your conviction will always be challenged in the short term. Short term can be 1 year, 2 year period.
How do you handle the pressure of, when the fund is underperforming?
These are phases of, sometimes the fund can underperform and then outperform. The mistake that investors have made is chasing a fund which has done really well.
Biggest myth about fund managers?
People think that fund managers know it all. They knew that this event is going to happen and then...
Hello and welcome to Ventura Spotlight. We are pleased to have with us today Meenakshi Dawar, Equity Fund Manager at Nippon India Mutual Fund. Meenakshi is an engineering graduate and is an alumni of Indian Institute of Management, Ahmedabad. Meenakshi has over 17 years of experience in equity fund management and in research. Since 2017, she has been a core member of the investment team at Nippon India, managing the value fund, equity hybrid, and the flexi-cap fund with assets over 21,000 crores. So let's get started. Hello, Meenakshi.
Hello. Glad to be part of this podcast.
Thank you for joining in. And just to know, it is piquing my curiosity. What got you into the, equity markets? What was the curiosity level that got you into the equity market and to choose it as a full-time career?
Yeah. I don't think it was a very conscious decision because, as you said, I've done my engineering. And then after an engineer, usually people, it's a set path. You do MBA. So I did my MBA. And there you get exposed to different fields, right? You do courses in finance, you understand consulting, HR, and all those things. While doing those courses, I had interest in financial courses and I really enjoyed them. So I wanted to get placed in a financial company, and the first choice that comes to everybody's mind is investment banking. So I wanted to do investment banking. But as things would span out, I graduated in 2008. Which was like peak of financial crisis. So suddenly in my campus, a lot of financial companies which were supposed to come, they just did not come. So then I got placed at an domestic financial institute, Edelweiss. And from there, my journey into equity started. So I started doing equity sales there, in fact. And within 1 year, I really enjoyed this field. And that was the first time that I got exposed to this field in true sense. And then from there, I made up my mind that I really want to move to buy side and really manage money in some period of time. And from there, my career transition started. From Edelweiss, I shifted to ISEC, and from there, I joined IDFC and then Nippon.
So if not a fund manager, what would have been your career path?
I think that's very difficult to say today, but the good thing about studying at good institutes is that they lay your foundation very strong. So had it not been equities, had it not been financial this thing, maybe I would have joined some corporates. In fact, the second offer I had at campus was a corporate role, and maybe started my career with a strategy team there.
Okay. So, we find that the fund management is, traditionally male dominated.
Yeah.
Right? So how do you see yourself fitting into a male dominated environment? I mean, do you feel any difference, or you find that it's the same environment?
Yeah, so that's a very good question. We all have biases and we all have perceptions. So a lot of time there is a perception that is created in the mind of people, or people have their strong biases that, this role is good for a woman and this role is good for a man, and man will excel here and maybe women will not excel as much here. But the good thing about about fund management is that the outcome is very, very measurable. So you can have your bias, but when you see data, it is very transparent because you know every day the kind of returns that you're making for your investor year on year. And when you can see this very objectively, it is very difficult to keep those biases. So in our industry also, there have been very successful women fund manager, and globally also you're seeing that trend changing, that you have very senior fund managers being women and managing large AUM. So in this industry, because output is so measurable, there is less space for biases, or what you think about is right. So for me also, the journey has been same. So because I started fund management and outcome was measurable, if you do well, nobody can stop you.
Okay. So good to see, that, gender bias is not there, at least in the fund management side as such. I think we find it more on the manufacturing side and a little bit over there. So good to see that. So one decision, which you can say that, you are very proud, and, it actually brings you like more like an aha moment, like, a smile on your face, that, whenever you think about that. So any idea which you felt was very good and
Yeah, in fact, like I said, because every decision of R can be evaluated with a hindsight, that what you did maybe a year ago, 2 year ago was a right decision or not. So, as a fund managers, we all make a lot of mistake, and we do a lot of right things, and we know by the end of a year or 2 year whether this was the right decision or not the right decision. I think for me, the big decision that went right was being very heavy on capex stocks after COVID. So the whole narrative of the market shifted from being focused on quality, growth, ROE, to suddenly a new set of companies which were coming after a deep bad performance or bad cycles, and building up significant position there was, I think, very good decision,
okay.
which worked really well for me.
So since you say, even talked about that, obviously we all make mistakes, and obviously we learn from that. So on the flip side, which is the one decision that you would actually want to forget and not remember it very very easily?
Yeah, I think there are a lot of them because I have been managing money for 10 years. So every year you have some stocks or the other, some sector calls which you think, oh, you with a hindsight wisdom that this is what you could have done right. Mm, but what wrong I did was maybe, in some of these large turnaround stories, having the faith that things will turn around and we should hold on to those stocks. But those turnarounds did not happen the way I would have imagined.
Okay. So any specific learning you would have had from that, or?
Yeah, the learning, I think the biggest learning is that when things are not going the way you planned them to be, or the way you anticipated them to be, you should not increase your weightage in those names or in those stocks.
Okay.
You should let things to play out, or only when you see it on paper and companies delivering those numbers should you take that call of increasing that weightage. Lot of times what mistake I've seen people doing it, and historically a few times that I did was averaging out your mistakes. Things were not going the way you wanted, and then the stocks correct, and then you average them down. That's the worst thing to do.
Okay. So then can you describe a moment where you have that you have a high conviction idea, you have gone through it, and you have, but the markets don't support, at
Yeah.
times, because the markets don't agree with
Correct.
what maybe your philosophy in terms
Correct.
of. So how do you then deal with that?
So that happens all the time. I think the biggest theory that we have learned while doing MBA or while learning finance was the market efficiency theory. That market is always efficient. That is, I think, the biggest wrong thing that you can learn from, because markets are most of the time inefficient. So on a longer period of time, they will become efficient. But when you are picking up stock and when we are identifying stocks, there is a lot of inefficiencies that exist in the stocks. So your conviction will always be challenged in the short term. Short term can be 1 year, 2 year period. But as long as you're tracking your companies, you are evaluating them on a regular basis, those inefficiencies in the market will catch up.
That means you rely a lot on data, right?
I do rely on data, yes.
Right now there is an overload of information with so much amount of data, it's being coming at and getting even contradicting views and all that, right? I mean, you get all different sorts of data floating around. Where does intuition fit into any of your ideas? Do you also look at intuition as one of the factors into your decision making?
I would not call it intuition. Maybe I would call it experience. See, one thing is to be able to predict earnings of the companies, right? That, maybe you talk to the people, talk to the whole ecosystem, you will figure out where the company is headed. The second thing is to evaluate or to have a conviction on that longevity of growth, which is, I think, very underrated. And that longevity of growth perception, that what you think, how long that this company can grow over a longer period of time, is where the experience comes in. So when you meet companies, when you meet the managements and understand the kind of vision they have for the company, the kind of energy that they are working with, that all becomes part of experience, or as you would say, intuition, that you get this feeling that this company is going to become big, that this company has all ingredients to become big. So that is a very significant part of decision making in investments.
Yeah, I think intuition is comes with experience. I
Correct.
think so that
Yeah.
that's a very valid point. I think, right? So
Or, when you're meeting companies, meeting managements, when you're very early in your career, you take everything at the face value, that this is what company is saying and this is what it is going to happen. But when you do this day and night for a longer period of time, you know that, when is it that the management is guiding you right? When is it that the management is not guiding you right? So this all becomes part of your intuition.
now we also see that the markets are like technically 24/7 because you have geopolitical events also impacting the markets, right? So you don't know what is going to happen when, right? So do you also carry the markets home, or and what? How do you disconnect? When you see that now you expect the markets will go south. I mean that's
Yeah.
the biggest challenge we face, right? So how do you disconnect yourself?
You very rightly said, these days, because there's so much information available, and in fact this social media has made it even worse. Everybody today has an opinion, everybody is trying to influence your thoughts and the way you think about things. The way I disconnect with the market after reaching home is, spend quality time with my daughter. So I have 11-and-a-half-year-old daughter, and that's the best way to disconnect and just be with her.
Okay, so you can cut down all the noise.
Yeah, that time you can.
Okay. In your stock selection, basically two things is there. You also mentioned that how you got the capex cycle right post COVID.
Yeah.
Do you believe in sector rotation, and do you also believe in churning the portfolio? I mean, what are your thoughts on that?
Yeah, that's for sure. That sector rotation does happen. In fact, style rotation also happens in the market. So that is there. So what happens is that market has a habit of extrapolating everything which has happened in near term. So whatever it has done well over last 2-3 years, market tends to reward them disproportionately, which we call, valuation multiples are disproportionate for those companies. But everything has a cycle. So every sector has a cycle. We have seen time and again these rotations between consumptions, capex driven stocks, IT, pharma. So every year you will have different set of stocks or different set of companies, sectors that do well. So that rotation is part of the game. So I don't think there is anything structural in the market. You can have that certain sectors that are more structural in nature versus other, but like I said, market then disproportionately values them, and when the things don't fall in line with what market has predicted earlier, you see those sharp rotations happening in the market.
And what about churning portfolio? I mean, how often do you do that? And
So we do churn our portfolios regularly. So every investments that we make, we evaluate it on a very regular basis. And then, typically, whenever we buy a company, we buy with an intention that we are going to hold it to 4-5 years. But some of the times when things are not falling in the way we had anticipated earlier, we are quick to make those exits. So we can exit the company in a matter of 1 or 2 quarters as well.
okay. And how do you handle the pressure of when the fund is underperforming? So I mean, how do you Because I think that's
That's
every
the
fund
biggest
manager.
challenge of this industry, that you are evaluated on a daily basis, in a sense that nobody external evaluates you. You yourself know your performance of how is your performance versus your peers. And I think all of us, all the seasoned fund manager in the industries, have gone through the phases where your fund would have underperformed versus benchmark or versus your peers. The best way to, I think, the deal with it is to not slip or not let go of risk management. So when things are not going right the way you thought, you should not take that disproportionate risk. Reevaluate again what is it that in your portfolio is going wrong, and then correct what you think are the mistakes with the same risk framework that you had earlier.
Yeah, because nowadays I think the newspapers, remind you more that you're underperforming
Yeah,
than
yeah. Correct.
anyone
Yeah, yeah.
else,
I
right?
think investors are more forgiving than intermediaries. Thankfully, over years, even investors have matured and have understood that these are just phases of any fund. These are phases of, sometimes the funds can underperform and then outperform. The mistake that investors have made is chasing a fund which has done really well, top gainers of this year or top gainers of last of 2 years, because things will normalize. So whoever is the top gainer of last year is not necessarily the person who is going to give you top returns next year. As long as the fund discipline is there in terms of fund construction, of risk management, things will just come back and fall in
No, so
place.
we had a very classic case because in the last, I think, 3-4 years, we have had a complete bull run,
Yeah.
right? So investors have got returns which are, I don't know whether call it abnormal or very high returns they have got. So the benchmark has changed for them.
Yeah, yeah.
I had a very peculiar question that a small cap fund had given a return of 43% in a year. The benchmark was some 65%. So he says we have underperformed.
Yeah.
So, it becomes a very difficult question. 43% is a good return per se, but
Right.
it's very difficult to answer it.
Yeah.
And when you're actually doing your stocks, selection per se, right? How important is return on equity as a parameter in your stock selection?
So return on equity is definitely an important parameter. It tells you the efficiency of the business, how capital efficient that business is. But I think you can't see ROE on a standalone basis. You have to see also where in cycle that company is. So is that company going through capex uh, period? So therefore ROEs are depressed. What is the reason for that ROE to be high or low is also equally important to understand. And ROE also has to be seen in line with cash flows. So if company is showing very good ROE on paper, but when you see the cash flows are not there. You can't just rely on one parameter these days, because I think companies have also become very smart in realizing that what is it that investor want, and they can tweak your PNL in the way they want, the investor wants it to see. So you have to see more other things in along with these typical ratios.
But
of ROEs.
what, according to you, would amongst other parameters, what would be a good return on equity in terms of where many investors who just want to look at that as one of the parameters amongst other.
So other than ROE, you are asking?
No, I'm saying what is a good return on equity? Is it a 15%, 16%,
So,
or or
any business over 20% ROE is a really good business.
Okay.
That you're beating your cost of capital by a reasonably high margin, and you have enough growth capital therefore available to you.
correct?
That's a very good number to work with. But if some company has done large amount of capex and the ROEs currently are depressed because the asset is underutilized right now, you should overlook that and
Yeah.
always look at what is the normalized ROE of that business rather than looking at what is the near-term
Yeah.
ROE of that
So not
business.
not just look at a 1 year parameter if
Yeah.
somebody's got capex. Otherwise, on a 20% above is actually a reasonably good
Good number.
ROE amongst other things. You need to obviously look at other factors. Okay. How do you remain objective? When we have got so many completely lot of biases around there are a lot of narratives going around, and so much of noise is there. So how do you keep yourself objective when you also have peer pressure in terms of performance? So how do you keep yourself objective?
I think the only thing is that you have to remain true to yourself. So narratives will keep floating around. Like you said, some of your peers will do better at some point of time, but there will be new set of peers that will emerge next year. The worst thing that you can do is chase what is doing well currently or in that short period of time. You have to remain true to yourself. If your style is off, like my style, if your style is about understanding companies, numbers, and then taking a call, you have to remain true to what works for you rather than getting too influenced by what is happening around.
And if you have to give, one advice to investors, then what would be your advice? We keep on saying that you have to come and invest for the long term. So there are certain things are already given. So any specific point that you would like to investors to focus on?
Although, like I said, investors have become far more aware than what it was when I started my career, that risk management of a fund or of a fund house is equally important as return generations. So don't undermine the way funds are constructed, where the risk is being taken, and just getting too influenced by what is the short term return. That longevity of return generation for you is far more important than what the fund has done in 1 or 2 years, because whenever the investor is coming, they are coming with the mindset that I have given this money to you, now you have to manage it for maybe 5 years, 10 years, 15 years. So with that mindset, somebody who is doing a good job in terms of maybe risk management, fund construction, etc., is equally important than return generation.
So not only to be guided by returns, and look at various other parameters as well in terms of, and even longevity.
Yeah.
It's okay. So if you had to go back and give your younger self a piece of advice, what would that be?
The piece of advice that I would go give myself, maybe early in your career, the more mistakes you make early in your career, the more resilient you will become later. So don't shy away from making mistakes. We all will make mistakes, but explore different styles, that explore what are the different ways in which the fund constructions can be done, and do those mistakes early in your career. Don't be too risk averse that things should be right all the time. That will not happen.
Okay, so you should take some risks.
Yes.
Okay. So great talking to you, and just wanted to do a quick fire with you. So one stock you regret missing?
I would not say stock, but maybe a sector where I had really high conviction, but because you keep trying to time it that this is not the right price, maybe I would buy it a little lower. Maybe the defense re-rating that happens in the recent past is one thing I would regret, that I would have sized it a lot bigger than what it was in the portfolio.
Okay. Tea or coffee?
Tea anytime.
Anything. And what is more stressful, falling NAV or not beating the benchmark?
Not beating the benchmark.
Okay. Favorite non-finance book?
Maybe, the book that I read very early in my career and I was really impressed with it was Rich Dad, Poor Dad.
Okay. And biggest myth about fund managers?
Myth about fund manager. Maybe I should ask you what people think about fund manager, but when I interact with people, I think people think that fund managers know it all. They knew that this event is going to happen, and still they didn't do it. That's not true. We also work with a lot of unknowns.
Yeah, so actually, I mean, when you are asking this question, what happens is that we find that most of the investors in hindsight are very wise, and they expect you to know it as a foresight.
Correct. Yeah. So that's the biggest challenge to tell people, and people assume that we knew that this is going to happen.
So
we also don't know how future would be.
They are talking in hindsight, but they think that you should have known this.
Correct.
So, P or return on equity?
Return on equity.
Okay. Yeah. So thank you, Meenakshi. Thank you for being. It was a pleasure having you.
Thank you very much. My pleasure.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully